Welcome back to another pipeline trading video. My first options guide. You learned how options work. Today, you will learn that option prices are influenced daily by three key things: the underlying stock's price, the time left until expiration, and the stock's implied volatility. But that begs the question, just how sensitive is an options price to each of these? For instance, if the stock jumps by 1 point, how much profit does that make for your call option? If a week goes by, how much value do you lose to time decay? And if volatility takes a 10% dive, what does that do to your options price? All these questions find their answers in what we call the option Greeks. The Greeks are fantastic tools that give us a clear picture of how an options price will react to shifts in the stock price, the passage of time, and changes in volatility. Essentially, they measure an options price sensitivity. Learning the Greeks is crucial because they guide us in choosing the right strike prices and expiration dates for our trades. More importantly, they help us understand and manage our risk, which is the cornerstone of successful trading. There are four main option Greeks we're going to dive into today: Delta, Gamma, Theta, and Vega. Let's start with Delta. Delta tells you how much an options price will change if the underlying stock price moves up by 1 point. So if an option has a delta of, say, 65 cents, it means that for every 1 point increase in the stock price, the option contract's value will go up by 65 cents. Let me show you a real example. We can find Delta and all the other Greeks right on the option chain. Just click on Layout and then select Delta, Gamma, Theta, and Vega. Voila! Now we can see all the Greeks for each contract. Notice something right away. Call options have a positive delta, while put options have a negative one. This makes perfect sense, since delta measures the price change from a 1 point increase in the stock. Call options gain value, hence positive delta. Puts, on the other hand, lose value when the stock goes up, so their delta is negative. Let's pick an example. How about this 50 strike call? You can see its delta is 59 cents. This tells us that if the stock price rises by $1, this option contract should increase in value by 59 cents. This is vital information because if you own one contract of this call, a 1 point stock move means you should make $59. It's pretty straightforward, right? But here's a key detail. Delta isn't a fixed number, it's dynamic. As the stock's price fluctuates, so does delta. And the rate at which delta changes is measured by our next Greek, Gamma. Gamma shows how much delta will change for every 1 point move in the stock. For this same option, the gamma is 4 cents. So if the stock goes up 1 point, the delta will increase from 59 cents to 63 cents. Now don't get too bogged down with gamma right now, especially early in your trading journey. Even I don't focus on it heavily for most of my trades. The main takeaway is simply understanding that delta is constantly changing. What's important to know is that as an option becomes more valuable, its delta increases. If you look at the option chain, you'll see that the deeper an option is in the money, the higher its delta. As you move out of the money, the delta gets smaller. For now, that is all you need to grasp about gamma. Delta gets bigger as an option gains value. Okay, so we've covered delta and gamma, which explain how an options price reacts to stock price changes. Now, let's talk about theta. Theta is all about time. It measures an option's sensitivity to the passing of 1 day. Let's say the option we're looking at has a theta of negative 17 cents. This means that if 1 day passes, this option will lose 17 cents of its value simply due to time decay. Now, this doesn't guarantee the option will be 17 cents cheaper tomorrow. Remember, the stock price and volatility are also moving. But if the stock price and implied volatility stay exactly the same, the option's price should drop by 17 cents. You look at the option chain again, you'll see every single option has a negative theta. Why? Because time is always ticking, and every passing day sucks a little bit of time value out of every option. When you buy an option, you're always in a race against this time decay. That's why sometimes trading in the money options with higher premiums can actually be more cost-effective in the long run. All right. One more Greek to go, Vega. Vega estimates how an option's price will change if the stock's implied volatility changes. Specifically, for every 1% increase in implied volatility, the option's price will change by the amount of its Vega. Looking at our example, its Vega is 3 cents. This means if implied volatility goes up by 1%, the option's price will increase by 3 cents. You'll notice on the option chain that Vega is a positive number for all options, both calls and puts. That's because an increase in implied volatility makes all options more expensive. So, to recap the four main Greeks, delta measures the impact of stock price, gamma measures the change in delta, theta measures the impact of time, and Vega measures the impact of volatility. We've seen how they work for individual options, but the really cool part is applying them to our entire position. Let us look at a current position we have in ticker symbol BMNR and check out its position Greeks. You can see the delta on this position is 65 cents. This tells me that if BMNR goes up by 1 point, the P&L of this entire position will increase by 65 cents. A positive delta like this tells me I am long BMNR, want the stock to go up. If it were a negative number, it would mean I'm short and want the stock to go down. So a positive delta means I'm bullish. Looking at your position's delta is also a great way to manage your directional exposure and make sure it aligns with your risk tolerance. A bigger delta means more exposure. Let's say instead of 10 contracts, I had 100. My delta would be around positive $6.50, meaning I'd make $650 for every 1 point increase in the stock. Delta is a great way to measure risk. But how do you know if a delta is big or small? Subjective, really, depending on your account size and risk tolerance. For those of you with experience trading stocks, here's how I like to think about it. Your position delta is like an equivalent share position. For example, if you own 50 shares of a stock, your delta is plus 50 because you make $50 for every point the stock goes up. So, if your option position has a delta of negative 10, it's like being short 10 shares of the stock. And of course, this delta will change by the amount of gamma as the stock moves. Again, don't get too fixated on gamma. Just know that your directional exposure can increase or decrease as the market moves. Now, let's look at theta for the position. Earlier I said all options have negative theta, but look here. When you structure a trade correctly, your position theta can actually be positive. This means my position is benefiting from time decay. For every day that passes, this position is actually making money from time decay. This is one of the core principles of the strategies we use here at Pipeline Trading. We aim to be on the right side of time decay. Finally, let's check the position's Vega. It's a positive 10 cents. This means for every 1 percentage point that implied volatility rises, this position gains $10. Conversely, if volatility falls, it will lose $10. Understanding these Greeks transforms you from a passive participant into an active manager of your trades. You can see your risks, your potential rewards, and how different market forces will affect your bottom line. This has been Pipeline Trading. Stay disciplined, trade with intention, and God bless. Thanks for watching, and don't forget to follow and subscribe for more content.